Now we try and twist it a bit. We try and delve a bit deep, and we will delve a bit deep now, building on all of these concepts over here by looking at arbitrage-free pricing and financial forwards. Then we'll move ahead by looking at arbitrage-free pricing and physical forwards. How do we determine the forward prices when we are dealing with financial forwards? I already said that financial forwards represent assets that are inclined towards or seeking exposure towards indices or fixed income instruments or based on, say, for example, the US treasuries, like that. That is what you're saying is financial forwards, financial assets there. Physical forwards, now you're dealing with, say, barley, wheat, physical commodities themselves. Now, the pricing over here will be very different. So we are going to look at it on this side. So we can say arbitrage, free pricing, and financial forwards. We can say financial or financed positions. You can say financed positions allow investors to acquire economic ownership of an asset without forfeiting the cash value of the position You can continue and say that financial forwards include, so that we're providing a description of what financial forwards are, include futures, contracts on stock indices, and also US Treasury bond futures. US Treasury bond futures. Now, we can be able to now build on what we've actually done over here. Notice what we've done over here. I can rewrite it with your permission. I can write it over here. We said FT is given as S, the transcendental value there like that, RT. That is what we said from there. Now, when we're dealing with financial forwards, the arbitrage-free pricing formula changes. We have FT, calling from this one over here, FT is given as, we have the spot price, we have the transcendental value there, and then we have R minus D, like that. I'll be able to explain what that is, then times T there. Notice what we had. We have the R. We've already explained what R is. R is the risk-free rate. Now, we'll also need to determine what the component of D is, and we are saying D is the continuously compounded dividend component. Why are we saying that? Because we're saying financial forwards tend to provide some element of dividends. If you're investing in financial contracts on stock indices, there is some component of dividend that you should be able to realize. So we need to remove out that component over there. Where where we are saying, of course, you define what FT is, the spot price, the continuous, the transcendental value. R, we've already said, is the risk-free rate. T is already the time is time component. And now where we'll define only what we've not defined. D is, you're saying, the constant dividend, continuous dividend. Continuous dividend there, like that. That is the only element that we need to describe. And in so doing, we now need to look at an example that can be able to highlight that component there. So the example reads as follows. The NSE 20 is currently trading at 1,555 shillings, and the risk-free interest rate is 4.5%. The current dividend yield on the NSE 20 is 2.2%. Calculate the forward price of a 6-month forward contract on the NSE 20. Now, we have already got all of the inputs. We just come over here, or you can come on this other side, please, with your permission. So we already know FT solution. FT is equals to S E R minus D time there. So the spot price is how much? The spot price for the NSE 20 is 1,555, like that. And then we have the E, then the transcendental value. R minus D, we have the risk-free rate. I can see the risk-free rate is 0.045, 4.5%, 0.045 minus the dividend. The current yield is 2.2%, 0.022, like that. And then the time is how many months? I can see 6 months, so it's 6/12, like that. 6/12, like that. So we try and get what the value is. Just as the way we've done it, we first of all work out this component over here. We first of all work out the brackets. You remember board mass? Saying board mass. Like that, so brackets. So you work out what about that component is, or rather the entire component over here. 6/12 is 0.5. So we're saying we have 0.045 minus 0.022. Like that, 0.023. Then you multiply that, because there's a multiplication sign there, times 0.5. We have 0.0115. So you can put that 0.0115 on the side there, like that. Now, once we've worked out that, we just work out now the complete transcendental value. We said is shift E1, we're saying is 2.71828. Then we raise it to power 0.0115, like that. We have 1.011. That value you multiply by 1,555. So that multiplied by 1,555, we get how much? We get 1,572.99. You can see that. That is the forward price, like that. So that is how we are able to consider that. We are saying the financial, please note, the financial forwards represent or have to have a component of dividends there. If it's a treasury bond, there it may not be having maybe dividends. It could be some form of maybe return on investment or the interest rate. Please slot in that interest rate over here, like that, convert it into decimals so that you can be able to get the forward price, like that. Now, having looked at that,